Hi, my name is Kris Venezia. I'm an advisor at Eckman Wealth Management. Today I'm going to be talking to you about the Federal Reserve, the Central Bank of the United States, and their recent decision to raise the Fed funds rate by 25 basis points, or normal people talk 0.25%. So the Fed has raised their Fed funds range to 5.25% and 5.5%. That has an impact of slowly making its way through the economy in different areas. So there's a lag effect from when the Fed does this to when you start to see this in other areas of rate markets like loans, interest on deposits, etc. The pros of this, I'll get right into it. Pros, more rewards for savers, right? So banks are competing more for deposits, rates are higher, it means high yield savings accounts are paying more than they have in a pretty long time. You're seeing banks compete for these deposits. So you are seeing out there some smaller banks with savings rates at above 5%. I've seen. You've seen good CDs that banks offer. You're seeing those 5+ percent. I've seen it get as high as 5.5%. Lending money to the U.S. government, treasuries, you can get over 5% there as well. So it's a way to earn return on items that are considered more conservative, and it's a way for people who have those small to intermediate term goals coming up, like saving for a car or a down payment in a year, those types of things that aren't long-term retirement savings, money you're trying to access in the next 1 to 3 years. There's a way for you to save money, earn some return on it without having to go too far in risks, which wasn't the case when you go back a couple of years ago. There really just wasn't much of a reward for parking money in a savings account or lending money to the U.S. government. Another pro, which just kind of goes hand in hand, but you're seeing more competition for financial institutions to acquire those deposits. So you do see more just incentives out there when it comes to where you park some of those savings. Cons, the obvious one, it gets more expensive to borrow. Car loans are the ones that seem to be the most reactive to this Fed tightening. We've seen car loans really get up there into the double digits, especially used car loans. You're seeing some pretty high rates there. See, mortgage rates are around 7% as I talk to you right now. I think the expectation is they're going to tick back above 7% pretty soon on a 30-year. Credit card debt gets more expensive. So, taking money out gets more expensive in a higher rate environment. Another con, and this goes hand in hand, it's more expensive for businesses and governments like state and local governments to borrow money. So, and this is what the central bank wants, but the reaction here is it could curb spending from businesses. It could curb spending from state and local governments when it comes to how they spend money because it's more expensive for them to borrow money. I think the other con, as the Fed goes on this path, right, these are rates we haven't seen since pre-2008. 2007 was the last time you saw a Fed funds rate at these levels. For what I'll call younger Americans, between 20 and 40 years old, they've never really, as an adult or as an older teen, never really been in this sort of environment. So there's a bit of shock, I think, to the younger American when it comes to how much more expensive it is to borrow money. Because if you're, I'm 30 years old, last time rates were at this level, I was entering high school. So for a really long time, after I graduated college, taking out debt was relatively affordable. I could take out debt at a pretty decent rate in terms of, if there's student loans refinancing that, in terms of buying a car, especially during the pandemic, you could really find some really low rates on those car loans. That's gone. So I think I worry about what this is going to do to that, 20 to 40-year-old cohort who for a long time has had really easy access to, relatively cheap loans, had an easier ability to go out and buy that car, had an easier ability to go out and get that mortgage. That stuff's getting a lot more expensive. That's going to be a shock to those younger Americans. It's certainly an adjustment that they're going to have to go through. And it's also a shock for the younger American because, as a 30-year-old, since I graduated college, I wasn't really rewarded for putting money in a savings account. And there are some of those savings and incentives out there to save in something that maybe isn't in the stock market. So certainly an adjustment as the Fed continues this rate path. The expectation at this point, it's like a 50-50 chance right now if you look at the futures market on a rate hike in September, which is the next time the Fed could have that rate hike, certainly depending on who you talk to. Some people are saying there'll be 1 or 2 more rate hikes. Some people are saying this is the end. The central bank of the U.S. is not going to raise rates anymore. The truth is, it really just depends on the data. If inflation data continues to decrease, if we start to see maybe a little bit of loosening in the labor market, the Fed has really talked about how the labor market's tight. What that means is it's hard for employers to go out and hire. If there's some movement there in the positive side, or what the Fed would deem as the positive side, more likely the Fed's going to halt this rate hike campaign. They've hiked 11 of the last 12 meetings. If the data comes in and inflation starts to pick up again, certainly you would expect the Federal Reserve to raise rates. I think there's some pros and cons on the inflation side. Energy has gone up a lot in July. Oil prices have gone up a lot in July, so that's certainly going to have an impact on inflation reports. Outside of that, you see other areas, though. Airfares domestically are starting to drop. It was a huge part of inflation on the transportation side. Expectation of shelter costs coming down as rents come down kind of on this year over year. Zillow has their report that says year over year rents are around 4%. That's continued to keep dropping as people renew leases in September, August, October. So there's kind of a push and pull right now on the inflation side. September's really up in the air as to whether or not the Fed hikes. But even if the Fed keeps rates where they are right now, it is a much different environment. Like I said, especially for that 20 to 40-year-old than they've ever experienced. And there's going to be some adjustments in terms of how that group of Americans, spends money, borrows money, and saves money. So once again, Kris Venezia from Eckman Wealth Management. Thanks for tuning in, and make sure to tune into some of our future videos.